Good afternoon, ladies and gentlemen. Welcome to the Liberty Call for Wednesday, Hump Day, July 13th, 2022. Hope everybody's having a great day out there. July 13th is kind of a memorable day for me. It's 30 years ago today. I enlisted in the Navy, probably one of the dumbest and smartest things I've ever done. So, some days it felt like it was the worst thing I'd ever done. And looking back, it made some good friends, learned some good skills, and, met my wife in Florida. So it obviously all worked out. Thanks, Jerry. I know you never watched this. So anyways, all right. Kind of a ugly bit of news came out today in the markets. I apologize for being a little bit late. I had my every 6 weeks infusion. So I was at up in Denver at one of the medical centers getting pumped full of poison to keep my arthritis at bay. So, but anyways, like I was saying, looks like the news about the inflation rate came out worse than what we were talking about over the last couple of days. And you can see over my shoulder, Jake is super excited. He is my deputy director of security around here at DSA Financial Group. So, even it makes him sad. So, all right, well, let's go ahead and see how the markets reacted to the news. The Dow Jones, why does this pop open every time? Dow Jones finished down 0.67% at 3772. S&P 500 was down 0.45, closed at 3801. NASDAQ was down 0.15 at 11247. Small caps are also down 0.16. Weirdly, the VIX receded today, 1.72%. It's currently sitting at 2682. So that is a little surprising. The VIX is tied to the S&P 500. And typically, when the S&P 500 is going down, the VIX goes up. So a little bit of a surprise there. The Canadian markets, they were down 0.34, Brazil down 0.4, Mexico down 0.4. Headed over to Europe, the German markets were down 1.16, UK down 0.74, France down 0.73, Eurozone was down 0.95, Netherlands were down 0.71, Spain down 0.87, Italy down 0.93, Switzerland down 1.49. That's the first greater than 1% since Germany. Let's see here. Let's move on down to the Russian markets. The MOEX was down negative 2.82. The RTSI was down negative 1.93. Oh, my nose is itching. Feels like I'm going to sneeze. All right. Headed over to the Asian markets. Japan was up 0.54. Australia up 0.23. New Zealand up 0.57. Headed over to China. The Shanghai was up, basically flat at up 0.09. SE component up 0.56. The China A50 up 0.22. The DJ Shanghai up 0.1. And the Hang Seng came in down 0.22. And the Taiwan weighted was up 2.68%. All right. So all in all, it looks like, the Asian markets overnight were pretty good. And the European markets, while down, none of them, or few of them were down more than 1%. So not anything to really get your panties in a wad over today. So, all right. So let's go ahead and read through today's market recap and see what they have to say about what's going on. Dow ends lower as high inflation stokes rate hike fears. Whew, scary. Scary stuff. All right. Starting out here, stocks wobbled, but ultimately ended lower on Wednesday as the fastest pace of inflation in decades. Stoke bets that the Federal Reserve will be forced to deliver a much larger than expected 1% rate hike later this year. Ooh, all those bankers are getting pissed. U.S. inflation rose 9.1% in June to hit a fresh 4-decade high, topping economists' forecasts for a 9% rise, driven by an 11.2% leap in gas prices and a 1% increase in food prices. This, quote, will be the last big increase, end quote, Pantheon Macroeconomics said, as margins fall, wage gains slow, and commodity prices decline. Quote, but right now, this report will make for very uncomfortable reading at the Fed, end quote, it added. With just 2 weeks to go until the Fed's July meeting, investors are now betting that the Fed will be forced to deliver a 1% rate hike, bringing the central bank closer to reaching a restrictive stance on monetary policy. Following the report, Atlanta Federal Reserve President Raphael Bostic fueled the further speculation of a 1% rate hike, saying, quote, everything was in play, end quote. The odds of a 1% rate hike jumped to 76% from just 10% a day earlier, according to Investing.com's Fed rate monitor tool. Bank stocks, which will be in the spotlight on Thursday as JP Morgan kicks off the quarterly earnings for major Wall Street banks, were hurt by ongoing concerns that a recession is on the horizon. Guys, we're already in a recession. We've had 2 negative quarters of GDP. I mean, unless some magical thing shows up in the reports for Q2, we're already there, folks. Wells Fargo, Bank of America, Citigroup were down more than 1%. The dip buying in tech was on show once again as big tech stocks pared most of their losses as Treasury yields retreated from session highs. Still, Apple, Alphabet, and Microsoft remained in the red. Twitter, meanwhile, jumped 8% after the social media giant sued Elon Musk to prevent him from withdrawing his $44 billion take-private deal. Again, I think this is all going to plan. I mean, not that I think Elon's like the greatest guy in the world. I mean, he's made most of his money, sucking at the government's teat, getting government contracts and all that sort of stuff. And so he's not a bad guy, but I wouldn't consider him a good guy. But I do think that the folks, the leftards who are all upset that they're going to lose their safe space at Twitter, they're the ones who are probably, that's probably the bigger problem is that, they don't want someone who's more neutral in that position, who's going to actually call it straight. And, for folks like me who are not part of the leftist contingent, I welcome it. But again, we'll see what happens. As a court battle between Musk and Twitter looms, the latter appears to have a, quote, strong iron fist upper hand, end quote, Wedbush said, with the stock now, quote, factoring in some significant chance that Musk will ultimately have to pay Twitter a settlement well north of $1 billion. The dude's worth over $100 million. So I don't think if you got $100 in your pocket and someone says, hey, do you have $1? Big deal. Stitch Fix climbed 13% after Benchmark Capital's Bill Gurley bought 1 million shares in the company at a price of $5.43. On the earnings front, Delta Airlines reported quarterly results that missed on the bottom line as rising fuel prices were a drag on margins, offsetting better than expected revenue. Its shares fell nearly 5%. All right, so not the best day, but again, if you've been watching this on a regular basis, this is not to be expected. We have to go through this river crap to get out the other side. And as long as the Fed sticks to what again, I don't give the Republic, I don't think it's going to make it to the end of the decade. I think things are going to fall apart to a point where we just give up on the federal government. But, and I'm cheering that on. But again, you can see Jake's excited. He gets excited about revolutions. But again, we'll see. All right, next article I got here. Inflation report sets grim markets tone as investors ponder 100 basis point hike. A surprisingly hot inflation report for June is complicating the outlook for markets as investors brace for more hawkishness from the Federal Reserve and continued volatility in stocks and bonds. Wall Street met the number, which showed consumer prices rising by a greater than expected 9.1% in June, with a collective groan. Analysts at Wells Fargo called the report rotten to the core, in quotes, while Bank of America global research strategist said it confirmed their recent call for a mild U.S. recession. So just mild, like a mild fever. It's like 99.6. Let's see here. Federal fund futures, which reflect traders' bets on monetary policy, recently showed a 70% chance of a supersized 100 basis point rise at the coming meeting, compared with a roughly 1 in 9 chance before the report, according to data from the CME Group. Quote, it's most likely we're going to have a recession because the Fed is going to have to act aggressively, said Chris Zaccarelli, Chief Investment Officer at Independent Advisor Alliance. Quote, unfortunately, we're looking for good news, and this is not good news, end quote, he said. The report fueled sharp swings in stocks, with the benchmark SP 500 falling as much as 1.6% before climbing into positive territory. It ended the day down 0.45% for the day. And it ended down 0.45% for the day and is off more than 20% this year. Recession worries have grown over the last few weeks. with several Wall Street banks calling for an increased chance of an economic downturn economic downturn brought on by a hawkish inflation-fighting Fed. Let me stop there. This was brought on by printing $5 to $6 trillion 2 summers ago. God, my beard's a mess. To stimulate the economy because of COVID. Like I've said, to probably every client I've talked to of late, we could probably have avoided all this by just getting back to business in May 2 years ago, and keeping those who are vulnerable safe. But no, it made more sense to just print money at like it's going out of style, increase the money supply by 39%, and damn the consequences. We'll be fine. It'll be all right. Well, a year later, last summer, we could already see these ripplings that that inflation was already starting to take hold. Fuel prices were going up. Our goods and services, or energy in general, went up last year, and which affected every aspect of our economy, every aspect of our lives. So anyways, quit blaming the Fed. The Fed's trying to put the fire out. I mean, granted, they were culpable in everything that happened, but I have to believe that there was one of the 400 economists who works at the Fed should have raised their hand and said, this is a bad idea, guys. We should probably not do this and just, let the chips fall where they may. All right. The International Monetary Fund on Tuesday warned that avoiding recession in the United States will be, quote, increasingly challenging, quote, as it again cuts its 2022 U.S. growth forecast. The inversion on the U.S. 2-year, 10-year yield curve accelerated Wednesday to as much as 24.2 basis points, the most inverted in nearly 22 years. Refinitiv data showed once again flashing a signal that it has preceded past recessions. Following the inflation data, traders of futures tied to the Fed policy rate swiftly priced in higher probability of a 100 basis point rise at the July 27 meeting. Central bankers over the past couple of weeks have already signaled support for a 75 basis point rate increase. Wells Fargo's analyst noted that upside surprise can be tied to mostly greater strength in core inflation, which strips away volatile food and energy prices. That could help set the stage for the Fed to hike even more than 75 basis points in July, they wrote on Wednesday. Quote, to be clear, a 100 basis point rate hike is not our base case at present, but yet another surprisingly strong CPI report cracks the door to such a move should the FOMC decide to bang that door wide open, end quote, the Wells analyst said in a note. The hawkish outlook for the Fed, compared to many other global central banks, also rippled through currency markets, with the dollar surging to a 20-year high against a basket of currencies, while the euro broke barely below parity against the greenback. The Bank of Canada on Wednesday raised its main interest rate by 100 basis points in a bid to crush inflation, surprising markets and becoming the first G7 country to make such an aggressive hike in this economic cycle. Some analysts said inflation could start to cool in the coming months, noting a recent drop in commodity prices. Peter Cardillo, chief market economist at Spartan Capital Securities, said, quote, the numbers are ugly, end quote, but added that, quote, the hints that inflation might be beginning to decelerate are there, end quote. Investors are now turning to second quarter earnings season, which just started, to reinvigorate the market. S&P 500 earnings are expected to have climbed 5.7% from the year ago period, but investors are skeptical companies will be able to achieve those estimates given the uncertain economic outlook, including high inflation that is raising costs for both consumers and businesses. Quote, we look for further market volatility as investors digest the combination of slowing growth, persistent inflation, and the likelihood that second quarter earnings season results in downward revisions for margins and profits, end quote, said John Lynch, chief investment officer at Comerica Wealth Management. All right. Well, again, this could have probably been avoided, and we probably wouldn't have had to deal with this sort of stuff. But hey, again, I'm just some guy, maybe some people with some actual Austrian economics influence in their lives should be making these decisions. These Keynesians are dumbasses who are going to bankrupt the country, and who's going to be on the hook for the bill? People like me, you, not the people who work for the government. They don't pay taxes. All right. Here's a funny story. Quote, July 13th will be the bottom. Here's why Jim Cramer believes that the market will soon bounce and have a strong rally through late August. And before I get into this, most people know I have a Jim Cramer, in my opinion, is a village idiot. The man is wrong consistently and somehow keeps a job on, I think, CNBC. His calls are just dreadful. And I'm not sure why people continue to watch him. It seems more like he's cheerleading, hoping that he can sway investors to continue to put cash into the equity markets. I don't know if he's getting bribed to do this sort of stuff. This is my own speculation, so take it with a grain of salt. But the man is just a fool. All right. After the SP 500 posted its worst first half performance since 1970, many investors are wondering whether the downtrend would continue for the remainder of the year. But according to CNBC's, that's where he works, Jim Cramer, we could be at a turnaround. Quote, I said to David Faber that July 13th will be the bottom. I said that in February, end quote. He reminds viewers. Yeah, he's smart. Cramer also uses analysis from market technician Larry Williams to show that the market could be ready for a rebound in the not so distant future. Quote, the last time we spoke to him about the broader averages in late May, he predicted that after some choppy trading in the market, the market would have a strong rally through late August. Right now, what he's seeing in the futures markets confirms that thesis, end quote. Let's take a closer look at the call. All right. So there's three types of market participants. Cramer points out that the Commodity Futures Trading Commission released data on the net holdings of three types of market participants every week: the public, large traders, and fund managers, and commercial hedgers. He explained that commercial hedgers are companies that are actually involved in a given industry, meaning buying the futures because it's part of their business model, end quote. And that's the group's actions deserve investor attention. Quote, when it comes to these three groups, Williams has told us that he thinks that the latter group, commercial hedgers, tend to have the best understanding of the particular sector because they are the only ones involved who are doing more than just gambling, end quote, Cramer said. He goes on to explain that commercial hedgers in stock futures mostly consist of banks, mutual funds, and governments. Quote, when these guys get very bullish in their positioning, even though the charts may look bad, it's often a great buying opportunity, end quote. Interestingly, commercial hedgers and big money managers don't always move in the same direction. Quote, especially at important bottoms, Williams points out that commercial hedgers tend to be bullish, while large speculators like money managers and, of course, the public tend to be bearish, Cramer remarks. Looking at data on the Dow Jones Industrial Average futures from late 2009 to 2014, Cramer notes that commercial hedgers typically increase their buying at important bottoms, and it's a similar story from 2015 to 2019. Cramer points out that the pattern is appearing again. Commercial hedgers are stepping up while they're stepping up their buying while money managers are selling. Which side should investors take? Quote, historically, when commercials and hedge funds are going in the opposite directions, you're much better off betting with, yes, the commercials, end quote, he suggests. Larry's right. Markets bottom when hedge funds throw in the towel and the public throws in the towel. And based on history, he suspects that's exactly what's happening right now, end quote. Well, will Williams be right again? Cramer likes Williams' technique because of his excellent track record. Quote, especially when it comes to clogged bottoms at moments when everybody else has given up, end quote. One example is Williams' strategy during the pandemic-induced market crash in early 2020. Quote, remember in April 2020 when everyone was terrified that COVID would destroy the economy and we might be headed for the second Great Depression? Williams said, buy, Cramer recalls. Quote, he said business would start rebounding and within weeks the market would bounce with it and that would be one of the greatest calls ever, end quote. I was one of those people who did not expect that the market would turn around so quickly in April of 2020. Again, I did not expect that our government and the Federal Reserve were going to increase the money supply so greatly and, basically drop money out of helicopters for the better part of a year. So, that's where I got that call wrong, and I'm here to admit it. But, again, my expectation at that time was that we were already due for some sort of a financial downturn. the markets, especially the repo markets, dealing with the interchange of money between banks back in late 2019 was a complete wreck. Things were getting out of control. The yield curve had inverted in the fall of 2019. So my expectation was, hey, we're due. Corona was just some sort of nuisance in the wind. And, but hey, gave them the perfect excuse to print a bunch of money, keep the economy going for another 2 years. And now we're dealing with the same problems all over again. All right. Other news, how a new Supreme Court decision could help you save for retirement. So little bit of information here that might help out you folks who are saving in retirement accounts. A recent Supreme Court decision could result in improved options for your retirement plan. The court sided with Northwestern University employees who alleged the university's retirement plan had excessively high fees and simply too many options. I don't think there's ever too many options when it comes to investing, but usually company plans kind of suck. You don't get a whole lot of choices. Quote, or next paragraph. In a 6-page opinion published last week, the nation's highest court vacated a previous U.S. Court of Appeals ruling in Hughes v. Northwestern, remanding the case back to the appellate court for reconsideration. While the opinion doesn't include a specific order or set of recommendations that will immediately reshape the retirement industry, the Supreme Court was clear. Plan sponsors fail to fulfill their fiduciary duty when they do not monitor their investment offerings and eliminate those deemed to be imprudent. The legal battle began in 2016 when 3 current and former Northwestern employees sued the school, its retirement investment committee, and several officials who administer the 403Bs plans. 403Bs are for like hospitals and colleges or schools and things like that. Very similar to a 401k. If you're an employee, you really don't see the difference. Alleging they violated the Employee Retirement Income Security Act of 1974, or as we call it, ERISA. The lawsuit specifically alleged the defendants failed to monitor and control record-keeping fees, offered, quote, retail class mutual funds and annuities that carried higher fees than identical share classes with the same investments, and offered too many investment options, over 400. Wow, that'd be nice, quite honestly, which led to confusion among plan participants. Again, I can see where that could be a problem. If you don't do this for a living, it's like reading Chinese sometimes looking at these investment reports. However, a U.S. District Court dismissed the case in 2017, and the U.S. Court of Appeals for the Seventh Circuit subsequently affirmed the lower court's dismissal. But the Supreme Court disagreed with the previous rulings in the case, asserting that the Seventh Circuit, quote, erred in relying on the participants' ultimate choice over their investments to excuse allegedly imprudent decisions. Wow, that's a mouthful. End quote, by the plan sponsor. Justice Sonia Sotomayor wrote the opinion, rooted the court's decision in a 2015 ruling in Tibble v. Edison International. In the case, the Supreme Court concluded that the fiduciary's failure to monitor investments and remove imprudent options constitutes a breach in duty, despite the fact that defined contribution plan participants choose their investments. Plan fiduciaries must imprudently evaluate the plan's menu of options to determine which are prudent, the court opined. But the Seventh Circuit did not apply the guidance from the Tibble case when it rejected the plaintiff's argument, Sotomayor wrote. Quote, instead, the Seventh Circuit focused on another component of the duty of prudence, a fiduciary's obligation to assemble a diverse menu of options, end quote, she wrote. The appellate court found the defendants offered plan participants an adequate assortment of investment options, including low-cost index funds. But that doesn't go far enough to satisfy the fiduciary's duty of prudence, according to Sotomayor and the justices. Quote, even in a defined contribution plan where participants choose their investments, Tibble instructs that plan fiduciaries must conduct their own independent evaluation to determine which investments may be prudent, included in the plan's menu of options, Sotomayor added. As a result, the Supreme Court remanded the case to the Seventh Circuit, where the appellate court may reevaluate the plaintiff's arguments and consider whether the allegations amount to a violation of fiduciary duty. All right. So what this means going forward, how will the Supreme Court opinion impact the retirement industry going forward? Plan sponsors will likely become more discerning when it comes to investment options they offer, according to John Reckathaler, Vice President of Research at Morningstar. In his most recent Morningstar column, Reckathaler wrote that plan sponsors will not only trim their investment offerings to reduce subpar options, but they will also pressure mutual fund companies to offer for more institutional class shares, which typically charge lower expense ratios. Reckathaler added that most plan sponsors will continue to trade out actively managed funds for passively managed, lower-cost index funds. That would all be good news for retirement savers. Nevin E. Adams of National Association of Plan Advisors, meanwhile, wrote that the plan sponsors will become more critical of the funds offered with a retirement plan in light of the Supreme Court's opinion. Quote, "It seems fair to say that there will now be a much greater fiduciary sensitivity to the issues of monitoring the funds on the plan menu, as arguably there not only should be, but always should have been," end quote. All right. So, I mean, I can see some good things coming out of this. I mean, if you could actually detach the company or your 401k savings from a company plan and just, do a self-directed. I mean, this is what I do for clients all the time. And I mean, every quarter I go through and evaluate, what my investment choices are for them, and, trim out stuff that either they're not performing well, or, I can get the same similar returns with lower expense ratios. So there's a lot of factors involved there. Is a particular fund or investment not meeting objectives? So again, your plan sponsors are supposed to go through this stuff, but unfortunately, most of the time they're just HR flunkies who, have some, wet behind the ears advisor in their office who's like, all right, yeah, pick these. And, I was one of those guys 15 years ago. So, anyways, all right. So like I said, this could be some good news, maybe detaching it away from employers so that your 401k is yours. You just do a salary deferral, through your payroll system, and it goes to, like in my case, Ameritrade or Schwab or whoever, and goes into an account where, you do it yourself, or maybe you work with a investment advisor like myself to help you, trim things down and make good choices. So anyways, all right. Well, that's everything I had for today. Hope I didn't bring too much bad news forward, but it is what it is. Again, buckle up. We're going to be going through some rough times. If you need anything from me, please go to dsafinancialgroup.com. My email address is right here on the screen. So if you want to send me an email, you're welcome to do so. Also, all my contact information is there on the website. If you want to book a meeting to go through your retirement plan or your investment allocation, I'm here to help all the time. All right. Well, like I said, if anybody needs anything from me, please check out those choices. I'll be back tomorrow with Thursday's Liberty Call, and hope everyone has a fantastic night. Bye, folks.